Hey everybody, welcome back to the Optometry Money Podcast. We're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I'm your host, Evon Mendrin, certified financial planner practitioner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time. And on today's episode, I welcome back to the podcast Mr. Erich Mattei, and we are really continuing a past conversation we had. In a recent episode, we talked about the motivations and best practices for bringing on an associate to the practice. And on today's episode, we hone in specifically on how practice owners can create a pathway from associate to partnership. And so in the first half of the conversation, we talk about the motivations and timing around why you would bring on a partner or co-owner to the practice. And then in the second half of the conversation, we talk about the actual structure of that buy-in and the percentages involved. We talk about how to structure compensation between different co-owners, and we talk about legal documents to review. And then lastly, Eric and I talk about our final thoughts. And so hopefully this is helpful to you if you're the owner thinking about whether and when it makes sense to add on an associate doctor as a part of your own succession plan, contingency planning, or whether you're an associate doctor thinking about whether you were wanting to know what to look for in that opportunity. Hopefully this is helpful for you. I put all of the links and resources we talked about in the show notes, which you can find at the Education Hub at my website, www.optometrywealth.com. And if you have any questions, you can reach out to me here at podcast@optometrywealth.com. And if you want to learn more about this topic and all things related to practice and personal finances related to practice owners, what you want to do is head over to the links in the show notes and sign up for my Eyes on the Money weekly newsletter. Each week, I bring tips or education around how you can make better financial decisions. And if you do, I'm going to send you a resource that shows you the most important financial planning numbers you need to know for 2025. And without further ado, here is my conversation with Erich Mattei. And welcome back to the Optometry Money Podcast. I am your host, Evon Mendrin, and I am excited to welcome back to the podcast once again, Mr. Erich Mattei. Eric, thank you so much for coming back on.
Evon, it's so great to see you. Thanks for having me back.
Eric, in a recent episode, you and I talked about the motivations and best practices for hiring an associate. And this is episode 124, so we'll throw a link to that in the show notes for the listener. But we talked about those motivations and best practices. And one of those motivations were practice succession, is passing on ownership of that practice to other associate doctors based on the desires of the current owner. And so it's that motivation, it's that process that I really want to dive into with you today is how do we create this pathway from hired associate doctor to practice partner, to practice co-owner? What does that actually look like? And so as we dive into this, I want to start with the basics. What are the motivations of a current owner wanting to bring on another co-owning optometrist? Why would an optometrist want to give up ownership of their practice? What are some of the motivations?
You know, that's a really, really great question to kick things off, Evon. And really what this all ties back to is a couple of core things. Number one, what's the future of that business going to look like from an exit standpoint, right? So typically when we see partnerships, there's typically going to be a senior partner and a junior partner, right? And realizing that senior partner may be eyeing their exit, whereas a junior partner is going to continue to grow and flourish into their new role, they themselves as the senior. So one motive is to be proactive in planning that exit plan, right? Motive number two has to do with something that we touched on a little bit in the last episode, and that's the degree to which optometry has a potential to scale. Now, it's difficult to wrap our heads around scaling an optometry practice, seeing as it's an owner-operator type business where we need doctors to be serving patients and such. But nonetheless, when you look at bringing multiple doctors under one roof that have complementary skill sets, that can position a practice to really hit a next level of growth that otherwise perhaps couldn't be done if you had a single doctor practicing kind of their single modality or bundle of modalities. So those hands down are going to be the top two reasons why doctors want to get into partnership. But also outside of that is, other things such as like, hey, simply the fact that I want to be in a business and run my own business, but it would be nice to have someone else kind of along for the ride, right? That teamwork, that camaraderie. Also kind of that balance of duties, right? And particularly when we look at folks maybe that have some strengths in one area and then someone else, the other partner may have some strengths in another area. So in a nutshell, what really is driving this interest in partnership, again, it's one of those three. It's going to be where you've got one party, presumably the senior member, who's actively going to be looking to approach their exit from the business on down the line. Number two has to do with purely growing and scaling, maximizing the potential and profitability of the business. And then number three is simply to have a partner in the business because you want to have that team, you want to have that collaboration that can afford many things, not only in the practice as far as operations and performance in the business, but also having that flexibility to perhaps take that vacation and do some of these other things that I know we touched on in our last episode were also some of the motives why doctors want to be in private practice in the first place.
Gotcha. And that first motivation, that exit planning is really important as you think about the role of the practice value on the owner's balance sheet. And it can be a significant part of their net worth as they're planning for other life goals, other financial goals, like just financial independence, being able to capture the value of all of that hard work, to be able to exit the practice on their terms, and then to enjoy retirement, to enjoy the next stage of their career, whatever that is. How do we preserve that value? Well, part of that is making sure that there's a continuity of care. Patients are continuing to be served in the same manner. Staff's going to stick around, and there's an owner willing to buy it. We don't have to go search around. We don't have to have a fire sale. There's going to be continuity of ownership and continuity of care. And when does an owner know that it's time to start thinking about this? At what stage of their career? At what age? What about timing?
Yeah. And Evon, I think that's where right now we're seeing a big mindset shift that, if you ask me, I believe is long overdue. That mindset shift being to go from, I want to be retired in the next year, so now I need to figure all this stuff out. That's the older way of thinking. The mindset shift now is I need to start earlier in my career. I need to be proactive in this. So we can kind of think, if we go back a few short years, right, the way that private equity was able to come and penetrate eye care, not just eye care, but all industries, right? The way private equity has been able to penetrate optometry, though, specifically, is that we had a large population of older doctors who were single owners who, as we touched on prior to hitting record today, were kind of keeping all this secret to themselves, They may have been thinking here and there about their exit, what's next. But for all intents and purposes, Evon, it was a secret. And it wasn't until they got that letter from the private equity or from the hospital system that wants to buy their business that all of a sudden they're like, wow, I can do this. So that has, again, kind of spurred this mindset shift that, if you ask me, is long overdue, where doctors can be empowered to be proactive in this journey earlier in the process. And there's a lot of other indications out there that shows that this is certainly going to be now, I believe, the way that many practices are going to start to evolve over time. And I think we'll unpack some of that probably in this conversation as well.
Yeah, interesting. You're starting to see that. It's not just a I need to retire next year conversation. This is more of a how do I bring those co-owners in earlier in that journey and have more of a gradual succession rather than sort of all at once. And that's interesting. I just think about the conversations I have, particularly with mid-career, earlier career owners, and there is a wide range of opinions on I have no interest in bringing on a co-owner versus I'm more than willing to bring on an associate co-owner because I'm looking at the growth opportunities of bringing on that owner and the partnership, as you talked about, the complementary skill sets that another owner can bring into it. So I've even seen sort of differences in opinion far beyond exit and just how those doctors feel about that. And we talked about those different motivations to hiring. one of these motivations to be practice succession. How does that impact what the owner looks for in that associate? Knowing that that associate's going to be co-owner, not just a great clinician, but also co-owner in the practice.
Yeah, that's a really, really great question there, Evon. As a matter of fact, it gets me to thinking of a practice that we work very, very closely with, a Picayune Eye Clinic up in Picayune, Mississippi. As a matter of fact, Women in Optometry just recently profiled Dr. Lori Blackmer, Dr. Hannah Massengale, who recently joined the practice. And actually, it's a fascinating article. It unpacks some of that, right? What this journey will look like, and some of Dr. Blackmer's motivations in bringing in this young associate, and particularly bringing her in with this explicit path to partnership. And then conversely, from Dr. Hannah Massengale's side, coming in as a young associate on this path to partnership. So it all plays into, really, I believe you touched on the continuity care piece, and that tends to be a really big motivator, right? Continuity of care, knowing that there's going to be that next generation of doctor to take care of patients moving forward, but also in advancing care. And that's another really exciting thing that we're seeing here with a lot of these partnerships and transitions, where we're seeing modern full scope optometry really come and make its mark in the practice. And that's where we see some really fascinating things unfolding, such as, you can consider a practice perhaps that was a really great thriving practice that was doing more primary care, comprehensive care, primary optometry throughout the duration of the practice to date. Well, now you have a young associate that's perhaps a bit more advanced clinically and in their medical billing, and can start bringing the practice from more of an old school optometric model to more of a new school full scope model. So, that being a huge motive in and of itself right there, Evon. And you want to talk about dollars in practices. I can't tell you how many practices out there have been hovering in that, $600,000, $700,000, $800,000 gross revenue with a single doctor practicing old school optometry. And you start digging into the data and you come to seeing, wow, there's this huge opportunity just in simply adding some medical services and billing appropriately for medical services. I mean, that's just the tip of the iceberg. We don't even have to get into talking about dry eye and aesthetics and myopia management and some of these fascinating specialties. Just simply in incorporating some medical into a vision practice can be huge. But truly across the board, no matter what way you look at this, we know that the public health need for vision, medical, and specialty eye care continues to advance. And this up and coming generation of modern optometrists, all of whom now have gone through school with full medical training. Increasingly now, they're even coming out of optometry school with training in lasers and minor surgical procedures, such as the case of that practice that I was referencing a moment ago, Picayune Eye Clinic, Dr. Lori Blackmer and Dr. Hannah Massengale. I mean, it's just really fascinating to see all these things come together.
So one of those things then, talking about complementary skill sets, is a clinical skill set or a clinical experience that adds maybe a new line of services or new scope of care for patients to expand that revenue opportunity and care opportunity for the community. So that sounds like that's something to look into. How about an interest or motivation to own? I'm assuming that's something you'd want to see in that eventual associate. How do you start to notice that? How do you ask about that if you're looking to hire that associate? What are some things you'd want to hear to see if there is a true opportunity or interest and motivation to own?
Yeah. Do you know how you ask about it, Evon?
Do you simply ask?
Let's role play, Evon. Let's say that you're Dr. Evon Mendrin, you own a practice, and I'm Dr. Erich Mattei. I'm a young, aspiring optometrist.
Okay. All right.
Ask me.
Hey, Erich, are you interested in ownership here?
Yes, Evon, I think I am.
Did we just solve it? Okay.
Evon, I think we just solved what I believe is going to unlock the next universe for eye care, specifically optometry. And it's just that. I think it's high time. It's 2025. It's high time that doctors feel comfortable and empowered to speak their mind, to ask a question. There's no need to beat around the bush. There's no need to keep things a secret only to have it wake you up in the middle of the night thinking about this and that. Just come out and say it, right? But it truly is. And that was, you'll recall, I even invited you before hitting record when you said, hey, Eric, what's one of the messages you really want to drive home? The biggest message I want to drive home to doctors, whether you're the established practice owner looking for a partner or exit, or whether you're the emerging owner looking for an opportunity, one thing to take away from this episode, be proactive, y'all. That's it. Be proactive.
And I can feel like there is this sort of temptation to keep your cards close, to not really show your true intentions for whatever the motivation is. Maybe you don't want staff to know you're thinking about exiting. Maybe you don't want to think about exiting yourself, or maybe you don't want to tip you don't want to show your cards to the associate. I don't know what the motivation could be, but I can sense that there could be that sort of temptation. And as you are kind of talking about right now, I'm not sure that helps anybody. If you are wanting to bring in an associate doctor that will own, it's in your best interest to market that so that you can find the best pool of candidates that want to own, and that you are certain that that associate doctor is going to be a good fit to co-own with you from the very beginning, right? Not years into it, but from the very beginning. And from the associate doctor, if they are motivated to own and are probably going to be a good fit for ownership, they're probably looking for that opportunity. And so from both sides, I think it is to the best interest of both to be open with that motivation, if that's something that you want to do. And you do have to, as you've talked about in the past, you do have to market your business. You do have to present it as something that another doctor would want to be a part of and sell, and that people know about. And so we don't need to keep our cards too close to the chest on this one. And a follow-up question, and I'm going to ask a couple questions out of this, but we talk about those doctors maybe earlier in their career. They own a practice. They aren't interested in sharing ownership just yet, but they do want to expand their ability to serve patients. And so they want to hire associate doctors while still working quite a bit in the practice. And so they hire excellent clinicians, excellent optometrists, great with patients, but those optometrists have no interest in owning. And they maybe wouldn't even be good fits for co-ownership for whatever reason. And so you kind of go through, if you project out the future career of that owner, there might be a pivot they have to go through, because their current associates aren't a great fit. Even if they're great clinicians, they aren't a great fit to buy the practice. They may be forced to sell to another third-party optometrist at the risk of the current optometrist leaving if there's not a great chemistry there. In terms of contingency planning, if something happens to the current owners, they can't be certain the current doctors will purchase from the spouse or from the estate. So how do you think about that sort of scenario and this sort of pivot that doctor has to go through? And you don't have to have a great answer here, but I'm just kind of thinking out loud. How do we think about that sort of scenario there?
Yeah, that's a really powerful question, Evon. And I think one of the things that it speaks to most notably is what it means to own a practice these days versus kind of old school, what did it mean to own a practice? Evon, and you and I have had a lot of conversations around this, right? Like running a business it's 2025, March of 2025 as we're recording this, right? But running a business now, and I'll say post-COVID world, post-pandemic, right? Versus kind of pre-pandemic. And the fact is there are more tools and resources and ways to systematize and streamline a business these days. Mm-hmm. And there are more ways to engage and promote and foster a strong collaborative culture in the office these days than ever before.
Okay.
I bring this up to say that when someone does not want to be in ownership, the reason why they do not want to be in ownership typically is not because they don't want to work for themselves and have their own practice where they can provide the scope of care that they want to provide to their patients and their community. Everyone wants to do that. The reason why doctors would not want to be in practice ownership is running the business. And that's where I point to the work that we do within Akrinos, our mission, make the business of private practice approachable, accessible, and profitable. The way you did it back in 1995, it ain't going to cut it in the year 2025. For that matter, very few things done the way we did 30 years ago are going to cut it. I mean, sure, you'll get by, but when we really look, take that 30,000 foot view. I know you're involved in some of the online communities. I don't do so much of the online communities these days, right? Although you can find me on LinkedIn where business happens, right? But as far as you go into the online communities, and you can kind of see how the deck is cut, right? You can only continue doing things the same way that we've always done them until, quite frankly, that way just absolutely fails us. And that's where I think getting back to the whole being proactive, that's where there's this whole industry of consultants, of software companies, of equipment companies that have amazing new modern ways of doing things that can eliminate so many headaches and drive so much profitability for the business. It's shocking. And you can see it again in the online communities. You can see those people that are chiming in that figured it out. They aligned with the right consultants, with the right equipment companies, with the right software companies. They were proactive in digging into their business, as opposed to those that are kind of more, hey, I'm going to keep doing this the old way because it's where we kind of feel comfortable. It's the way it's always been done. I mean, a really good example is paper charts, and there are members of our audience out there. Well, there's a lot of folks that think like, wow, at one time there was a paper chart. Yes. At one time, there was a time before EHRs. Okay. But I use that as an example because although the adaptation from paper to electronic, there were some headaches, there were some learning curves in it. 99%, you ask 99% of them are going to say, would you ever go back to paper? Heavens no. Because there are now so many workflows that are hinged on that EHR. And these are workflows that in the paper days, you want to talk about staff being irritated with having to do mundane busy work. Holy cow. I mean, let's go back in our time machine and see the mundane busy work that people were doing 25 and 30 years ago. So Evon, so where I'm going with this is the reason why folks would not want to be in ownership of the business is not that they don't want to have autonomy in their patient care and autonomy in their decisions. Everybody wants that. The hesitation is in running the business, because what comes to mind is the way that the businesses were run by the past generation. And I'm here to say that if you embrace modern approaches to business, a lot of these headaches and hangups that you saw the old generation dealing with, you're not going to have to deal with.
So where my brain might go to, okay, there might be ODs out there that simply don't want to ever think about the business. They want to show up to the clinic, work with patients, go home, and not think about it after that. Where you're saying, well, no, if you improve the processes and technology of the business, you can remove, maybe not entirely, but you can at least limit the burden that the optometrist would face getting into ownership and make that ownership opportunity more enjoyable. Is that what you're saying?
Exactly. Yeah.
Okay.
More approachable, more accessible, and more profitable.
Okay. Interesting. I'd be fascinated to hear from the listeners what your thoughts are on that, and maybe what you've done to see those improvements in your own business, or maybe if you were an OD that stepped into that position, what you saw as well. But one follow-up question then out of this sort of same scenario, in that it seems that there are ways to do this either simply by being the sole owner of the practice and hiring great clinicians and stepping away from full-time patient care and managing the business. And then at time of exit, when you're sort of thinking about that time of exit later on in life, that's when you sort of go through that. That's sort of maybe the older way, or one of the common ways you see that done. And then there's the more of the earlier journey co-owner pathway, where there are co-owners earlier in that. There's more of a built-in succession plan earlier. What questions would you ask of a current owner to sort of lead them and help them decide what makes the most sense for that practice in that situation?
Yeah. That's a really, really big question.
Yes.
But the number one is timeline. Number one is the timeline, because the timeline determines, well, Evon, just about everything, right? And we can think, I mean, obviously, like in the work that you all do, Optometry Wealth Advisors, I mean, it's all about that time horizon. You know, how far are we from that? And, you know, consider the planning and the approaches that you all take with clients. Say they're early, maybe, you know, early in their career, expecting their first child, versus, you know, I'm 15 years in and I've got a couple of school age children, maybe early teens. And then, oh, wow, you know, I'm 25, 30 years in and I got kids in college or out of the house. You know, it's all about the time horizon, number one. And then from there, all of these different fascinating combinations that these deals can come together, right?
Right.
And it's also continuing that time horizon that we understand, okay, what is the timing of that path to partnership going to be? You know, is it appropriate for someone to start as a junior partner or become in 50-50? I mean, really what we're wanting to stay away from is finding situations where doctors are forced into asset sales.
Yes.
I mean, and I say forced into an asset sale. It's one thing to proactive full asset sale, but it's another thing where you're in your mid-late 60s, your spouse has been hounding you for years to hang it up, and now you've finally gotten to a point where you're just done. You're worn out. And that is so real life, Evon. And that's actually, I mean, that's a big thing. That's a big thing that why I'm so passionate about the work that we do, you know, because we want to be sure that folks that have poured their life into building their businesses have something amazing to show for their work in that business, and also have something amazing to bless their community with moving forward. And those blessings happen when it's that next generation of the independent owners that are coming in. And we see it across the board. Look, I wrote that essay that the Review published a few months back. I think we actually did our last recording was right around the time that it was published.
Right after that.
And we're looking at these stats. You know, we're looking at the stats, and the stats are this, y'all. When we look at healthcare here in the U.S., we know that provider burnout rate is through the roof. Cost of care continues to climb. The overall quality of care and patient experience is in the skids. When we look at private practice as a segment of that broader healthcare system, we see that the rate of provider burnout in private practice is less than national benchmarks. The cost of care is lower, and the quality of care and patient experience is through the roof. As a matter of fact, patients prefer going to private practice at a rate of 4-to-1 over corporate, big box, private equity, you name it. So we're talking about stakeholders here. We're not talking about one doctor selling this business to another doctor and how much is this one going to retire with? How nice of an opportunity is the new incoming doctor going to have to grow and thrive in this business? But we're talking about stakeholders, and these stakeholders are across the board. It's doctors, it's the team they employ, because small business drives the workforce and communities all over, and private practice employing. And then third, the patients there in the community. So we're talking about private practice. It's truly stakeholder rich as far as all of the stakeholders are going to be impacted by these decisions. And I would challenge, in which environment are all the stakeholders best served?
What do we know with certainty? We know with certainty that you, listener, will exit your practice at some point. We know that. It's going to be unexpected or it's going to be expected, planned for. But at some point, you're going to exit your practice. And the question is how? And how well are you thinking about that ahead of time? And how well are you planning for that? Because it can be on your terms. It can be exactly as you desire, assuming that you've done well to plan financially leading up to that, and that you've done well planning on the business side leading up to that. It can be on your terms, and you can plan for the unexpected as well. The question is how. And as I think about this timeline you talk about, and we can move on from this question I'm asking, but as I think about this timeline, I do feel like earlier mid-career owner is going to be more motivated by separation of duties, by the skill set of another owner complementing their own. I feel like earlier in a career, the motivation for co-ownership is, to me, very likely going to be more motivated by complementary skill sets and growth opportunities of the business, or time, time management for the owner, that later in the career, as they're getting closer to exiting, it sounds like it's going to be much more motivated by not only skill set, but more motivated by exit of that initial owner doctor and just planning that succession out of the business. Do you feel like that's what you've seen as well?
Yeah, absolutely. And as a matter of fact, I think something that speaks remarkably well to that is the following. So Evon, I'm very grateful and privileged to have the opportunity to do some work with the American Optometric Association Center for Independent Practice. And in working with their team, specifically what I do is I will go into the optometry schools and teach the students business. As a matter of fact, next month, April 25, can't wait to get out to the Kentucky College of Optometry there at up in Pikeville. And what I've picked up in doing these speaking events, these campuses, is that there is a ton of interest in practice ownership. I mean, a ton of interest in practice ownership, Evon. And the fact is that where there's this huge interest in practice ownership, to build on that, it seems that a lot of these emerging practice owners are interested not so much in going and cold starting their own thing and kind of reinventing the wheel, but a lot of them are looking to become a partner and or purchase a practice that's already established. So it's fascinating that you mentioned that regarding earlier looking for complementary skill sets, distribution of duties and stuff. So we definitely see, I believe, in our up and coming generation of practice owners, there's a rabid desire and excitement and interest in getting into private practice, but also they are looking for opportunities to come in, join an established practice, learn how to run a business, learn how to run a profitable business, and go from there, as opposed to perhaps generation or two ago, heck, maybe even as simple as, say, 15 years ago, where there was less interest in practice ownership and perhaps more interest in the cold start piece. Gotcha. So to build on that, also something else that I wanted to mention that kind of plays into this, and that is later in career when looking for partner, and this whole context of kind of like, when is the right time to start doing this? If we're waiting as our window of opportunity is closing shut on our career, that funnel's getting smaller and smaller and smaller. What does that mean? Less options. Which means what? You could have worked your tail off for decades and decades and decades, but every year you wait to share it with the world, to promote it, to find someone to come in, every year that you wait, your ability to actually sell that thing at a really good price is getting smaller and smaller and smaller. Right? Yeah. And especially if a prospective buyer is working with consultants, right? Because they know how this works. Right. So the message to the owners: do not wait. Do not wait until you're ready to do it, because you're going to take it on the chin. You're going to be leaving dollars on the table, as opposed to if you do it earlier, ideally when you're still in the peak earnings years. The ultimate would be to pull a partner in when you're still actually growing those peak earnings years. That's the ultimate. That's the win-win-win for everyone involved. You can get top dollar for your sale. That top dollar for your sale will be fully justified through the valuation and through the due diligence of the buyer. Again, if these things are continuing on a growth trajectory, then if that buyer has a complementary skill set where we can then open up revenue even more, this is just a super win-win-win for all parties involved. But it doesn't happen if we're sitting on the sideline waiting, right? Evon, the heartbreakers are when it's gone too long. And to that end, actually, I'll share with you something that we just learned of towards the end of last year, in that we came to connecting with a doctor who owns a practice, brought in an associate on a path to partnership. That associate was working 2 or 3 days a week with them. And then that associate was also associating the other 2 or 3 days a week 2 towns over. in a practice that so happens to be a good friend of the other practice that this young doctor is associating in. Fast forward, a couple years go by, associate buys practice B. Now get this, Evon. Associate came to town to associate with practice A, associating this practice on a path to partnership. This practice didn't have the volume to support 5 days a week, so this associate then went and associated the other 2 or 3 days a week 2 towns over, where they were able to pick up the extra time.
Interesting.
And by the way, that introduction came from practice A. Oh yeah, you need some more time? My buddy 2 towns over in practice B could use some help. 2 years in, associate bought practice B,
leaving owner A without many options.
Owner A effectively gets this associate to come to the region to employ this associate on a path to partnership. Associate is looking for more hours. They start associating in practice B. 2 years later, they buy practice B. What did practice B do that practice A didn't do?
They had that conversation, it sounds like.
They asked the question, Evon. They had the conversation, Evon.
Yeah.
And that's got to change, man. That has got to change. And that is happening so often. And it's heartbreaking, right? It's absolutely heartbreaking to all parties involved.
And I think it even goes further than that. Yes, market your business. I mean, you are selling an asset, right? You are presenting it for sale. You need to market your business so that you can get the best qualified candidates for purchase. But you also have to present it in a way that shows that the cash flows of this business are not super risky. You think about that owner going into it. What are the stresses of that new associate? Well, the stresses are family life, mortgage, potentially student loans. They're going to feel the risk of taking on additional debt, potentially taking on business ownership duties, the uncertainty with business ownership. And so, well, how do we help that associate doctor feel better about that transition? Well, you present your practice as an opportunity that doesn't carry substantial risk. Well, how do you do that? Well, number one, we're going to go down the road here. We have clean, accurate, timely financial statements. So you can present clean, accurate data. You can track data about how that practice is doing. Number two, actually have a practice that's worth buying. Have an optometry practice that's working well, working with your peers, working with consultants like Erich, to make sure that your practice is operating in a way that a buyer is going to want to buy it. And we can start to go down this road. You do have to present your business as something another associate doctor is going to want to buy. Understanding that you as a seller probably built the business from scratch, has all the attachments of the identity of being that business owner, of those years, that capital built up in that business, those years with the patients, understanding that there's two parties to this transaction and each one has to feel comfortable about the risk and opportunity of that transaction. And we talked a lot about timing, motivation, purpose in doing this. Let's talk a little bit about structure. Let's say that owner doctor brings on that associate. And I didn't even ask about what the associate should look for in the practice to know that it's a good opportunity for the associate. But maybe we'll save that for another conversation.
Evon, we should do an episode
did a due diligence
devoted
episode.
to due diligence.
I think we've done one already. If we have, I'll throw it in the show notes. So listener,
there we go.
Please listen to that because there is some due diligence on your side too, buying associate. But let's talk about structure. That hire happens. Both parties agree it's a great fit. Everyone's happy. How do they structure that transaction? Where do they start?
Yeah, it's a really, really great question, right? Because there's all sorts of ways to go about doing this. Okay. So for starters, this is going to be a stock sale, right? So that associates will be buying stock in this business. So as far as structuring this goes, a lot of it ties back to timeline. And in so doing, we come to thinking that timeline and we think of our clinical performance, clinical production, right? We think of executive duty, and then we think of profit, like as being a shareholder of the business. And this is where things get really fascinating when you start talking about what you were mentioning a moment ago regarding how is business cash flowing. What is an appropriate price based on how it's cash flowing? Can an associate afford this? But it's not until we look at the business from those three angles, we understand the clinical production, clinical responsibilities of the partner in meeting those needs, right? We think of the executive duty and executive function of the partner, because when you are in business ownership, it's more than just seeing patients and going home, Although now more than ever, I will argue now more than ever, you can absolutely do it, thanks to a lot of resources and tools that are out there. And then the third piece is going to be the profit share. Now, the reason why I bring those up in fielding this question regarding how to structure it is because there's going to be a debt service that incoming buyer, that junior partner is going to have to meet. In addition to debt service, they also have to put food on the table for their family. Yeah. So that's how and why when you're looking at the actual feasibility of this stuff. And by the way, there's a lot of things that play into this. I mean, there are personal assets. There's, debt to income ratio. Do you own a home? How many dependency? I mean, there's a whole world of underwriting that banks will get into. We're going to stay away from that for these purposes. We're going to focus on the business, right? So in as much as underwriting would include analyzing the business, we need to understand that there's going to be those three streams of income coming to that junior partner. And it's not until we can really understand how are they impacting clinical profitability, what is their share of executive responsibility, and what is their share of the profit share, then we can see how much money is flowing to the partner. And then you figure out, okay, based on what's flowing to the partner, what is appropriate for them to be covering in debt service, realizing they still will likely have a house note to pay. If they have a family, they got to put food on the table, et cetera, et cetera.
Right.
So in that regard, that then will set us up for what's an appropriate tranche for that first step into partnership. Ideally, you go at 50-50 or 51-49, like get it as close to 50-50 out of the blocks. There's a variety of reasons for that. I mean, but primarily it's a simplicity thing. However, there are occasions where entering in smaller tranches is appropriate. And typically that appropriateness ties back to what kind of lending, how is the business cash flowing today that the junior associate can buy in? What's an appropriate amount? Gotcha. So that's where, and it all ties back to there's a fascinating world around all of this with so many options available, Evon. And I got to tell you, I feel also very confident that if doctors were aware that there's all these different ways that this stuff can go, right, I think simply based on that awareness, more doctors would be more comfortable and more confident in being proactive and speaking up. Yeah. But I think right now a lot of people kind of think like, oh, it's an all or nothing. Like I don't open my mouth until I'm ready to sell my business and retire. Yeah. And typically retirement is something we don't plan until, very short time horizon, as opposed to if we think of, and when I say, you want to plan for your retirement through your entire career. By the way, if you're not, you absolutely got to connect with Evon. You're not planning for your retirement. But in the context of planning it over your career, to draw the line in the sand and say, that's going to be the year, that's usually something that people are doing 2, 3, maybe 5 years max. Mm-hmm. But what we're talking about in partnership starts even before that, right? Gotcha. Maybe a 5 to 10 year, or heck, perhaps even longer than that. I mean, if you ask my good friend and collaborator at GRT Summit, Dr. Paul Mormon, how they're doing things, it's fascinating how Paul, he's actually, perhaps you should actually have him on the show, Evon, Dr. Paul Mormon, to talk about a little bit about how they're structuring it to get.
I might need to, yeah.
To get these really, get younger doctors on this path to partnership very early on in their career. And this also means that as the senior doctor, it's not like you're in your 60s as a senior doctor, but now this really kind of changes the script for doctors in bringing in partners.
It sounds like timeline of the selling doctor. How long do they want to be involved in the business? What is their timeline to exit? That might dictate a little bit of that timeline of the structure. And as you mentioned, it doesn't need to be all or nothing. It can be. if that's what the situation calls for, but it doesn't need to be. There might be this anchor point, as you mentioned, somewhere close to 50-50. And I've heard varying opinions on some people wanting to keep 51% to maintain control. Others are saying, no, make it 50-50. So both owners have a say in the business. I don't know if you have any particular thoughts around that, but there might be this anchor starting point, and then you can structure the length of it from there, knowing the selling doctor's time horizon. And as you mentioned, it also seems like it depends on maybe the size of the practice, or maybe just the business goals of the current owner. In that, I'm thinking about some relationships I'm fortunate to serve and work with, in that it's a larger practice, but they're bringing in multiple owners. And so multiple owners are buying smaller chunks over a longer period of time for a much larger practice. And that works for the current owner's timeline, as you mentioned. It works for the current buyer's cash flow and timeline as well. It works for all parties. And it obviously works for patients because there's this continuity of ownership and continuity of care. So have you seen that it also depends on sort of that business goal, ultimate business goal, or the size of the practice as well?
Yeah, absolutely.
And what are your thoughts on financing? Because it can be third-party financing through a bank, could be owner financing through an installment sale. Maybe there are some tax considerations involved there. What are your thoughts on that?
That's very much a case by case, Evon,
Gotcha.
Right? Because you'll see it all. We'll see using banks. We'll see, fully bank funded, fully owner financed, some sort of combination. If the bank is this, but the owner's saying, I want this for my business, and they'll get this from the bank for that bill of sale, and then have something worked out for an owner financing piece. So it really ties back to everyone's goals and end game. Gotcha. But it does make it cleaner when banks are involved and you can get the funding from a third party, and that transfer of those funds can happen like that. It does make for things to be nice and clean.
Yeah.
Right. And that's not saying that there aren't amazing things. Again, we've got clients we've worked with projects and have active clients that are using all these different combinations. It's truly a case by case, but when you have a third party that's provided that financing so that the seller can get their money, it just makes for things to be really, really, really clean. Especially, Evon, and this doesn't apply so much to this conversation as we're talking about like partnership and stuff, associate to partner. But think of that next step where, say, it's a full asset sale, right? Or that partner buys out that chunk from the retiring doctor. So now you have one owner, what have you. Anytime an owner is going to stay on the payroll as an employed doctor, we would definitely want to highly encourage those funds coming from a bank.
Gotcha.
Because things can get kind of complicated when it's owner financed and that former owner is now employed in the business. It can just kind of get sticky.
You think about that. Okay, you've sold your practice. You're working in the business. Your ability to get your paycheck from that sale relies on the decisions of the current owner, no longer you. You're seeing those decisions, probably going to be second guessing a lot. Hey, that's not how I would have done it. I would have done this. And so you can see how there's some complicated dynamics that could unfold when the seller doctor is still involved in the practice in that situation. And I agree, from a financial perspective, I'd want to model these different variations to see how it impacts the planning for the selling doctor, particularly the retirement planning and tax planning. How are we going to create income? In what order are those things going to come in? But there's sort of a balance between risk and accessibility for the buyer. Risk for the seller, if you're doing owner financing, the longer it takes for you to get your dollars, the more risk there is to that, especially if you're not involved, meaning if it's not an installment sale while you're currently an owner. If it's an installment sale and you're going to be exiting, then those dollars are entirely up to the ownership abilities of that buyer. And so there's some risk to you, the seller, if you're doing owner financing, especially if you're no longer involved in the practice at all. So you need to make sure that the interest rate on that owner financing is appropriate. But there's also some accessibilities, meaning the buyer can more accessibly buy into the practice and take over, even if it's over time. And so there's sort of a trade-off. I do think it's cleaner when the seller can get their money from a third-party bank and everyone can kind of just move on from there. What about structuring compensation for both sides? If you have two doctors still there, two owners, is it really just looking at the duties of each and then sort of structuring that together? What are your thoughts on that?
Yeah, it kind of ties back to some of what we touched on earlier in the conversation as well, with those kind of the three responsibilities, right? So the three responsibilities of co-owners are going to be clinical. We got to be seeing patients to get dollars coming in the door, right? They're going to be executive duty. Okay, so as from a running the business standpoint, now we kind of have this division of labor from an executive standpoint. And then the third is going to be the profit share, right? So as far as structuring the comp, think clinically, you get a piece of what you see. So, and it would make sense that if one partner is seeing more patients than another partner or has higher rev per patient, whatever the case may be, it would make sense that you're benefiting more based on the work that you're doing. Okay. So clinical comp based on clinical production, executive duty based on duty. So make a list. Sometimes typically it's a list of about 10 duties, and then you can find ways to, kind of distribute these accordingly. And definitely as it pertains to executive duty, definitely want to play on strengths. As a matter of fact, you look at a lot of partnerships where you have a senior partner and a junior partner, and it's beautiful to see how organic those strengths are, right?
Yeah.
There's a lot of newer things, particularly on the marketing front, and some other operational things where younger doctors are really plugged into new modern ways of doing this. Versus when you look at, say, cash flow and finance management, that's typically one of those areas where a younger doctor may be wanting to learn a bit more from that established doctor, right?
Gotcha.
So that's our executive duty piece. And then the third is going to be profit share. And that's just purely based on percentage of ownership.
Yeah. That's a great framework. And a lot of it, there's going to be a tax aspect of how that entity is taxed. With an S corporation, you're essentially adjusting the wage. I mean, that's your biggest lever. The profit distributions to the owners have to be pro rata primarily for the most part. So the biggest lever you can pull there with an S corporation is going to be the wage. With a partnership, whether it's an LLC taxed as a partnership or otherwise, you have a lot more levers to pull and a lot more flexibility. And so how that entity is taxed determines a lot of that. There are some attorneys that will layer the underlying entity as a partnership to give you more flexibility, and each owner will have their own separate entities. So for tax planning purposes, I mean, this really just goes to show that you do need a really good team around you as you're going through these conversations. Have a great attorney in the mix so they can review and create good legal documents. Have a good tax planning professional in the mix, whether it's a CPA or enrolled agent, EA, so you can talk about these different levers, these different opportunities for doing this as well as you can. Legal aspects, we talked about the attorney. I'd love to hear if you have any insights on this. Some things that come to mind for me. This is going to be an immediate review of operating agreements, if it's an LLC or if it's a corporation shareholder agreement. Certain states in California, you're going to have to be a corporation, professional corporation. So shareholder agreement, buy-sell provisions in these documents are really important so that if certain triggers happen, death, disability, divorce, conduct detrimental to the team, all these D words, there's a clear trigger to purchase someone else's ownership. And then how is that going to be funded? So for example, if it's death or disability, you can very often insure that through insurance, life insurance, disability, buyout insurance. Very often there's going to be other provisions like the ability to purchase over X amount of years at X interest rates. So all of those provisions in these documents are really important, which the attorney needs to be really involved in. Erich, do you have any other thoughts on the legal documents involved here?
Yeah, you hit on a lot of really remarkable things. Okay, so you're going to need the bill of sale. That bill of sale has got to explicitly state everything that's going to be involved in there, right? So that's basically saying, so bill of sale is, hey, this is what percentage of the business is being sold to them, and this is what's all included in that, right? Second to that, I love how you touched on the operating agreement. Evon, and to listeners out there, get it all sorted out on the front end in that operating agreement.
Yeah.
The calls that we love, the calls that teams like Akrinos and Evon, I would imagine yourself also, like the stuff that we love is when people are like, hey, we want to enter a partnership. This is super exciting. Get it done for us. Okay. Those are amazing. Those are exciting. The calls we hate. Hey, I'm in a bad business marriage. And one of the first things you do when you discover you're in a bad business marriage and ain't working out is you go to that operating agreement. And that's a real heartbreaker when we're getting calls, people that are in incongruent partnerships.
Yeah.
And you go to the operating agreement and there's like nothing there.
Yeah.
So an operating agreement is so absolutely vital, right? The third thing, Evon, buy, sell, that's something also that is absolutely vital. And know that the bank is going to require buy, sell and funding a buy, sell. But above and beyond that, it's important that the business also, and for partners perhaps to have their own arrangements and other insurances that are going to put money directly into the business. That's a very big disconnect. Understand that buy sells, they come in different functions. There's different ways to fund these things. And really, really important. There's a lot of misinformation out there around insurances as well, Evon. So I'm really glad you bring that up. Then another piece also that's really important on the legal side of things, you need a lease. If you're on one of these month to months, and this perhaps applies more to doctors that are looking to totally sell out as opposed to a partnership, but even so, if you're on a month to month lease, or you're, within a year of your lease and you are not yet renewed, you're not going to be able to sell that business. You're not going to be able to bring in a partner. That partner or that buyer is not going to be able to secure financing. You have got to have a place to call home for this business for the foreseeable future. So, I mean, look, Evon, everything else could be lined up. And then you have a landlord that's been on a lease to lease with the tenant. Why? Oh, the tenant's been there for decades. The last official lease expired 2 years ago, but the landlord's keeping the optometrist around because they've been a great loyal tenant for all these years. But, why don't they want to renew the lease? Because when they do a renewal, those rates are going to go up to a market rate. You're not going to be able to sell that thing. You're not going to be able to remove a partner, at least not within your sort of conventional financing. You're going to have to figure out some sort of owner-financed arrangement. Evon, I love how you mentioned risk, right? There's more risk in owner financing than there is in working through traditional banks.
Yeah.
There's huge risk if you don't have a place to call home for this business. So now we start to see these things line up. So be sure you have a lease in addition to all these other legal documents. That lease has got to be tight to ensure the future of that business.
Yeah. I love what you mentioned. I've actually not seen that where there's a month-to-month lease going into the sale. One thing I'll add is that if for the buying
you won't see it because the sale fell apart before it got to that point.
Okay. Yeah, interesting. And one thing I'll add for the buying doctor, as soon as you take full ownership, have that operating agreement looked at again. I've seen situations where whether it's a single doctor or a husband and wife doctor team fully purchase out their ex-co-owners, the operating agreement was too strict on how it required them to send out dollars to the owners, didn't give them enough flexibility now that they owned it fully. So that is another trigger. Okay, as soon as you own the business fully, that's another trigger to go talk with the attorney, review that, make sure that operating agreement allows the rules of the business allow you to do what you need to do, and it fits the current situation now. And so we've talked about, Eric, we've talked about motivations, timing, we've talked a lot about structure, and I think one big takeaway for me is that there are a lot of ways to structure this. It doesn't have to be all or nothing. You can tailor these transitions in a way that makes the most sense for the seller's timeline, the buyer's ability, and what makes the most sense for everybody. And so I'd like to just talk about final wrap-up thoughts. What, something you'd like to leave with the listener. And one thing I'll say, I'll go first because it's my show. So I'll go first. Why not? The earlier you can prepare for these things, the better it's going to be, both from a business perspective. You can make improvements to the business where they need to be made. But from a financial perspective, the earlier you can plan and the better you can plan financially outside of just the business equity, the more optionality you're going to have when you want to exit your practice. If you do not prepare well, Meaning if you are not regularly taking the cash flows of your practice to first reinvest into the practice and then to balance out your net worth with other assets, if you're not doing that throughout your career leading up to this point, and you are reliant entirely on the value of that practice, you may not have the options you need if your entire ability to be financially independent relies on a certain valuation. That may limit the type of sellers you can sell to, and you may not like the deal that you're going to get in order to get that price. And so the earlier, the better you can plan financially outside of the business and in it, the better off you're going to be, the more options you will have as you get to that point. And as I say that, I fully understand that there are optometrists out there maybe listening that are very intentionally building up large multi-location practices, purchasing locations, building in locations with the sole intention of selling for a very high sale value. And so you're building enterprise value. And the difference is that you're taking on that dynamic intentionally. That's not always the case. Very often, the business owner finds him or herself at that point later in their career, just simply having not been well prepared financially for that point. And so the earlier you can start preparing, the more options you're going to give yourself. And then please rely on your team. This is me now talking as an advisor. Yes, the financial advisor is important, yada, yada. Make sure you have a good consultant walking you through the business aspects. Make sure you have a good tax professional, a good attorney, a good banking partner. Make sure you have these people on your team because this is a big transaction. This is a big career move, a big life decision for everybody involved. And so have the people you need to have involved there. Erich, final thoughts from you.
Final thoughts. And to build on that, because I could not agree more with that, Evon, it really is, look, it's about the team. It's about a team, right? I mean, just like patient care, listeners out there, you can be the most amazing doctor eye care has ever seen, but you can only go so far unless you have that good team in office, right? Your experienced technicians, your opticians, your front end team and all that, right? So think in the same way there, you can't go it alone when you're taking care of patients. You can't go it alone when you're doing these sorts of business milestones. So that is absolutely vitally important. And Evon, I suppose my leaving thought, if yours is build your team, work with a team, my leaving thought is all about proactivity. Be proactive.
Got it. Love it. Well, Erich, I appreciate your time. This was great. We'll throw all of these links, resources, anything we mentioned in this episode in the show notes for the listener. And appreciate you listening. Would love to hear your thoughts or experience about going through this yourself. Questions you have, send that over to us. And we will catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.